Welcome back, everyone, to another episode of Unpacking Transfer Pricing series, where we aim to simplify transfer pricing concepts for our listeners who are intrigued by transfer pricing. Today, we will discuss Chapter 6, Special Considerations for Intangibles of the OECD Transfer Pricing Guidelines 2022. As always, this isn't professional advice, and for specific situations, one should always reach out to actual transfer pricing consultants. These episodes are just to introduce the concept and build your foundational knowledge. A link to a detailed audio-only description is available in the comments section below. Let me give you a heads up that from Chapter 6 onwards, things will get intense and a bit more technical, but we will try to keep it simple for larger audience. So, let's start. The Chapter 6 of OECD Transfer Pricing Guidelines, 2022, address the transfer of intangibles, emphasizing their unique and valuable nature. Intangibles are neither physical nor financial assets, but can be owned or controlled for commercial use. Their transfer between independent parties would require compensation, reflecting their potential to yield greater future economic benefits. Let's never get confused between intangibles and services. Intangibles are non-tangible assets that drive profit and are unique, irreplaceable, and warrant a premium due to their potential for high future income. In contrast, services are not very unique. They are replaceable, where cost is directly proportional to benefits. Examples for intangible includes brands, technology, and contracts, etc., while information technology, management, and legal services are typical services. Transfer pricing methods like profit split, comparable uncontrolled price, and valuation apply to intangibles, whereas cost plus is usually used for services. Some intangibles we hear often. Lease, licensing, and franchise agreements are key contractual intangibles. Copyrights, literary, and artistic works fall under artistic intangibles. Patents, software, and proprietary technology are technology intangibles. Brands, trademarks, and customer lists are marketing intangibles. Group synergies and market characteristics, or access, are not intangibles, as they cannot be controlled by any one entity. Patents are exclusive rights to use an invention for a limited time, enhancing profitability. Trademarks, including names and logos, differentiate products, aiding market penetration. Trade secrets involve proprietary knowledge that boosts commercial activities, but largely remain unregistered. Rights and licenses offer exclusive access to natural resources, enhancing strategic advantages. Goodwill, while intangible, cannot be sold separately. Development involves generating ideas and strategies for creating intangibles. Enhancement focuses on improving these assets to maintain performance. Maintenance ensures ongoing functionality and revenue generation. Protection safeguards the intangible's value legally. Exploitation refers to utilizing these assets to generate profits. Each aspect is crucial for maximizing the potential of intangible assets. Legal ownership of intangibles doesn't guarantee full profit entitlement. Profit allocation is based on significant DEMPI activities. Key is to identify who performs value-creating activities. For instance, a company funding research and development without controlling research or bearing risk should only earn a financing return, not full profits or DEMPI return. Intangible-related transactions between related parties often lack comparability with those between independent enterprises. Ownership and use of intangibles by different group members complicate delineation. Integration levels in DEMPI activities differ from independent enterprises, and contributions may not align with returns. Contractual terms separating ownership, risk, and funding from key functions can lead to base erosion and profit-shifting challenges. Analyzing contractual ownership involves examining legal obligations, roles, and responsibilities of parties in DEMPI functions. It's crucial to identify specific intellectual property used or transferred and assess economic risks. Consistency between contractual arrangements and economic substance ensures alignment with the arm's length principle. delineating ownership versus DEMPI for risk and return allocation. Pricing intangibles involves assessing various factors, as we will learn next. Exclusivity impacts pricing. Exclusive rights can exclude competition, unlike non-exclusive rights like franchises. Legal protection's extent and duration are crucial, especially for intangibles with limited lives. Geography matters. Global rights are more valuable than limited ones. Consider the intangible's lifespan, development stage, and future development, enhancement, maintenance, protection, and exploitation rights. Analyze expected benefits, considering all factors affecting profitability. All these are crucial for pricing an intangible. When transferring intangible property, sellers often rely on the comparable uncontrolled price (CUP) method, using recent sale prices of similar intellectual property, or a valuation method based on discounted future income. Buyers may also use comparable uncontrolled price or the royalty relief method, calculating the present value of expected royalties over the intellectual property's usable life. The profit split method, PSM, is applied when both parties make unique, valuable contributions. The business operations are highly integrated, and there is shared assumption of economically significant risks. It requires a two-sided functional analysis review, FAR, or value chain analysis, VCA, to delineate transactions accurately. PSM is suitable when comparable benchmarks are not easily found, and parties share economically significant risks. When applying the profit split method, one may choose between residual and contribution analysis based on FAR analysis, use of transactional net margin method, or cost plus to provide for routine functions before progressing with residual PSM. Identify key value drivers like people, cost, sales, and assets, etc. for each specific case before carefully choosing the allocation key. Weigh these factors carefully, as they are subjective and industry-specific, yet crucial for accurate profit allocation. Recharacterization of the transaction by tax authorities is not uncommon, and often involves assessing whether payments are for royalties or services. Royalty payments are tied to intellectual property usage, often subject to withholding tax, while service payments are based on effort or time and may not attract withholding tax. Clear documentation and aligning contracts with actual conduct are crucial to mitigate risks like tax disputes and double taxation. If possible, seek advance agreement with the respective tax authorities if the amount involved is significant. Hard-to-value intangibles, HTVI, are challenging due to their partial development and novel exploitation methods. Transferred for a lump sum, they lack comparable records, making cash flow projections uncertain. Often used in connection with cost contribution arrangements, CCA, these intangibles require careful consideration of their unique characteristics at the time of transfer. HTVI has few characteristics such as, it should be partially developed and not be a HTVI itself, like a Russian doll. It should be transferred for a lump sum, should not be royalty-based. It should ideally be years away from being commercially exploited and be with novel usage plans. HTVI present valuation challenges at transfer. Consider a pharmaceutical test drug in early trials, transferred to a low-tax entity at a low price. If it later becomes a blockbuster success, tax authorities can use actual profits as evidence to reassess initial pricing using hindsight. Significant deviations between financial projections and actual outcomes, altering HTVI compensation by over 20%, can trigger scrutiny, barring unforeseeable events. Hindsight is restricted unless ex post results were reasonably predictable at the transaction time. Taxpayers must justify their assumptions, as tax administrations rely on provided insights due to limited comparable data. Some major takeaways should be that before transfer, know your intangible well on its own merit. Do a proper functional analysis to ascertain risks and assets involved and how and where the benefits have transferred. Entities who took decisions and assumed risks should be the one with actual return and not the ones who simply funded the project. Choose the appropriate transfer pricing method, document thoroughly, and consider global tax impacts. Advance agreements with tax authorities can mitigate scrutiny and potential penalties. So that wraps up today's episode. Nothing beats actual reading, so do consider going through the pages. Okay, that was quite a lot for this episode. We have 4 more technically rich episodes to go, so do stay tuned. Until then, ciao.